now. Awesome. We've got the slides in the right direction and we are off and running. Well, yeah, welcome to the profit improvement webinar that we're putting together for our audience. And I guess for this one, as with all of our webinars, let's keep our cameras on where possible. And I like to make this feel more like a workshop than me talking to a computer. So thank you for those who have the webcam switched on. Good to see quite a few familiar faces. And also the way that these slides work, obviously you can see them over on the right-hand side of me here. The text is a little bit better if Zoom is full screen, or at least bigger than minimized somewhere in the background. The other thing is have the chat box handy. I did mention to people who've already been joining me that this is a bit of a on the road setup for me. So I've got a crate turned upside down on the bed, and I've got the mouse and keyboard in a weird position. So I'm not going to be able to keep it, and I've only got one screen. Normally I'm working off two. So please bear with me if I don't see your questions, but I do have the chats, the chat screen open on the right-hand side. So, and thank you, Tanya. Yes, it is a beautiful view. This is down in the wonderful Coolangatta in the Gold Coast. All righty. Before we get stuck into this webinar, I'll just mention what we've got coming up. On the 20th of August, we've got an estate planning and asset protection special. We've talked about this one a couple of times before, but our focus is on running through what business owners need to keep in mind when it comes to estate planning, what sort of documentation you have in place, and also asset protection to make sure that the wealth that we build up over our lifetimes are protected, but also passed on in the most appropriate way that we want them to be. And a brief introduction, I can see quite a few familiar faces, but for those who this might be one of your first times interacting with us, I'm Ben Walker and I run a accounting firm in the Fortitude Valley in Brisbane, Queensland. And we work with small business owners all around Australia. One of our big focuses and what we're known for is saving our clients tax. And that tally, since we started counting in 2015, has ticked over $46 million, which is mind-blowing to think how that sort of ticked away in the last 10 years or so. And that's not all we do. We definitely focus on other parts of helping our small business client base, with things like estate planning, asset protection, but also what we're going to be talking to today, which is around profit improvement and how to, I guess, look at your business in the lens of wanting to increase the financial benefits that it provides. Just as a personal introduction, I started Inspire when I was 23 years old, and we've been going for about 13 years or so. I'm an award-winning chartered accountant with over 17 years total experience now, and the author of 2 books, Wealth for Life, and It's All Sorted, and there is a third one on its way called Total Financial Control, which is very much the content we're going to be talking about today. We do have copies of It's All Sorted and the other one available, Wealth for Life. But if you did want a copy of those, then the QR code is on the screen, or one of the team has probably already popped the link in the chat box for me. Now, if you are a client, just make sure to get a coupon code for us. So we can give you that one at no cost as well. All right. Now, in terms of what we're going to cover today, there's a few different topics. And what I'm going to do as best I can is draw from my own experience and what I've seen running Inspire, but also seen from our clients and the insights we've got from them. We're going to have a look at pricing is definitely one of those conversations, cash flow management techniques, because sometimes I sort of think that profit's important, but we want to make sure, like, what at the end of the day, what's cash in the bank look like, and really cash flow stress is, I rarely hear, oh, I've got profit issues. The most common thing is, hey, I've got cash flow issues, and I think that's the thing we definitely need to master. And we're going to talk about cost control measures and also, what does future-proofing your business look like? And I think, like, even if you've got a good profit, I think we need to be constantly doing everything we can to protect that profitability, but also increase it if it is possible. All right. So The first one here is reconnecting with your why, and I feel like, I mean, this is a little bit woo woo for an accountant to be talking about, but I think this is extremely important to consider when we're talking about profitability because at the end of the day, you could be billing or walking away with 100 grand in profit, and that could be totally okay. There's nothing to improve because you've already hit your goal. Um, and so why I pop this one here is I want to know, and I want you guys to get clear on where you want to end up in terms of your goals. And I feel like I ran a podcast for quite a while, and one of the questions was, why did you go into business? And pretty much all the answers came back to whether it was increasing the amount of money the person made, or the time they have to spend doing other things than earning an income, or also like fulfillment and purpose. So those three things, often all three of them was the answer. And so what I want us to get clear on is where do we want to go? And even answer for yourself. Like, why did you start your business? What one of those three is the most important? And are you achieving your personal vision in business? Uh, and like, I guess for me, I want to be able to measure these things. And so if we have a look at time freedom, what does that look like to you? Do you want to be working 4 days a week, school hours, or I always remember going back to the previous firm I worked at. There was an anaesthetist who worked 9 months of the year and 4 days a week. It was awesome. He was often on holidays, and he used to come into the accounting firm with with a Hawaiian shirt on. And Steve Clark, I've got my resident heckler private messaging me. I thought that was a public message. Uh, all right. How embarrassing, Steve. All right. But yeah, so again, like, what does time freedom look like for you? I want the flexibility to be able to pick the kids up from school, not necessarily every day, but to help Stevie out, and ideally to be at the dinner table for every dinner I can absolutely make. That's part of that time freedom for me. Um, and if we go to financial reward, again, I think this is probably the easiest one to put a number on in terms of like where we're at now, which I'll talk about shortly. But what are our targets here? And I think the things that can help get an idea of what your target financial or your profit, your cash that you walk away with from your business might have something to do with your living expenses, plus your goals in terms of whether it's you want to invest in property or put some money away for retirement or build your wealth, and then having a target that you aim for in terms of that production from your business. The last one there, joy and alignment or fulfillment, I might call it. Often we go into business and thinking that we want to do fulfilling work, go and help people in whatever field we're in, and again, I think that's worth just taking a stock take on how fulfilled we feel at the moment doing what we're doing. What I admire is that most of our client base love what they do and love the impact that they have on their clients, ourselves included. Not every day is rosy and fun. Have the ups and downs, but again, I think it's just important that we do check in on that fulfillment piece as well. So again, I think and what I want to do throughout this webinar is give you actionable things to do as a result of the ideas I'm sharing. And one of the things that we can do in this first section is rate yourself on those three things right now. What sort of time in hours per week are you putting into your business? What sort of profit are you taking out? And my lens for that is generally annually, but you could do it every month, or if you've got a relatively stable business, or where it's month to month, pretty predictable. And then similarly, the joy of fulfillment. The best thing there, or maybe the easiest thing, is rating on a scale of 1 to 10, 10 being absolutely stoked, 0 being not so much at all. All right. Oh my goodness, one screen is challenging, but I'm making it work. Next one here. Know where you are now. So if we go and plug a destination into our GPS, like Coolangatta, and we don't have a starting point, it's not going to be very helpful. So what I think we need to do is work out where we are now from a profitability perspective, now that we know what we're aiming for. And what I'm talking about here is literally like, what does our profitability look like right now? What's our cash balances, and what are we taking out of the business on a week to week or month to month basis? And I feel like there's some key points here that make a very big difference. The first one here is timely, detailed reports. Now, I haven't seen this in a very long time, just because of the maybe the sort of clients we work with. But in the early days of me in accounting, I used to see that clients did their bookkeeping like every quarter. And the driver or the thing chasing them to do the bookkeeping was actually the BAS. And I feel like it's not really the reason why you should be doing bookkeeping. Bookkeeping should give you the information that you need to make better financial decisions. And there's a key word there, timely, being, my recommendation is at least by 7 to 10 days after the month has just finished, you've got last month's reports, and you're able to have a look at what's happened from a sales perspective, all your expenses, and you're able to make decisions and adjust things to move forward. The other part there is detailed. And what I mean by that is, most financial statements require you to have maybe about 20 different sales and expense accounts. And I feel like that's from a compliance perspective to lodge with the ATO. And even then, the ATO don't see all of those things, because the tax return even summarises those into smaller sections. But the point I'm trying to make here is that if you've got a business that's doing hundreds of thousands of dollars or millions of dollars in revenue, and you're working with about 20 different accounts, unless your business is super simple and there's not much going on in terms of categories of expenses or things you spend money to, I don't think that your Xero reports or whatever accounting system you use, Steve Clark with MyOp, I'm going to get you back here. But whatever reporting system that you're using, you want to make sure that your reports are extremely detailed. And, for instance, I'm pretty sure our own profit and loss statement has about 100 lines. Every single employee has their own wages line. Every single, not every single, but pretty much most of our subscriptions have their own section, and we can like literally account code, and we can see that on our really detailed P&L. Now, the reason why we do that is because it's super easy to see trends. It's extremely easy to notice when things are wrong as well. Like, let's say there was a double payment, it'll just stand out so much more than if you had subscriptions and you had about 300 different monthly subscriptions go through that account every month. You're not going to see the detail of what's happening unless you click down and drill down and drill down. So it could still happen, but it's going to take you a lot longer to identify those things. So again, recommendations is spend time detailing out what account codes and income and expense lines are going to give you the best visibility to see what's happening. And if you don't have bookkeeping systems in place to get you timely reports soon after the month has finished, then that would absolutely be an action point. And that's engaging really a good bookkeeper to help you out. The other one is, or the next one, is things like, I was talking to a client where they're still raising invoices a week or two into, so when the month is finished, like let's say we are the end of June, over the next week or two, they're still putting invoices in for the previous month. I feel like, again, that's really not going to help get timely reporting. You're essentially like working off late data, or if you go into your reports, you're not quite sure if these are finished yet, so to speak. And I've already spoken to that second point there of poorly structured chart of accounts, or what I'm thinking there is not enough accounts to at least quite quickly get meaningful reporting. And I don't necessarily think that heaps of accounts are a bad thing. In Xero, you can group accounts. So we've got subscriptions, in its own section. So we see the total of subscriptions, but then the breakdown. You can group, you can even create multiple different profit and loss statements so that you can have one that we lodge to, as or prepare as part of the financial statements with 20 to 30 accounts. But then you've got your management reports, is what we call them, to help you manage the business, where you've got 80, 100, depending on business, 200 accounts to run through. The next one here is accruals basis reporting. Now, just some pretty simple examples I'll give you where what the outcome is it creates inconsistent monthly expenses, if that makes sense. So let's say it's the month of April and you get your annual invoice from your insurance broker. And that insurance invoice covers you for the following 12 months. Now, if you pay for that whole invoice in the month of April, from a cash basis, that's an expense in April. But from an accruals basis, what we should be doing is apportioning that expense over the following 12 months. Because even if you're in May or June, 1/12 of that invoice is going to relate or cover that period. The other thing where you get inconsistent amounts is with wages, where you pay weekly or fortnightly wages. And so our recommendation and what we've been doing at Inspire for quite a while now is paying monthly wages, because literally it's the person's salary divided by 12 months in the year, rather than 26 fortnights or 52 weeks. Because with weekly, you'll get some months that are 4-week pay runs, some are 5, and with fortnightly, you'll get some of your pay runs, which are some of your months which are 2 pay runs months, or some are going to be 3. And that'll just throw out or show lumpy profitability, when from a true accruals, like if you're going to do it on a day rate almost, you should see a very balanced flat line when it comes to that person's salary or the insurance bill, assuming it stays the same throughout the year. And so there's 2 examples that, where accruals does make a big difference. And it applies to anything like, I've got subscriptions that are paid quarterly in advance, and, instead of just putting the invoice in and treating it as an expense in that month, we've got to do a manual journal. It's a bit of extra work, but we'd manual journal it so that, it's a prepayment first, and then we take 1/3 of that expense every month for the quarter and put that in the P&L. So just want to see visually that that's all making sense so far, what we just spoke about then, but I guess everything so far. Awesome. I'm seeing some nods. Fantastic. Very good. All righty. We've still got people joining. I guess at the end of the day, what we want our reporting to do is to be able to help us make better financial decisions. And I guess this is a thought or a concept that we will build on as we go through the rest of the content now. The next topic here, and this is one that I'm quite passionate about, and it's the lever of price when it comes to being the best to increasing your profit. And apologies, I've got a alrighty. So when it comes to price, it's definitely the most impactful thing to increase your profit. I'll give you an example. If you've got $1 million business making $100,000 in profit, that's a 10% net profit margin. We're sort of giving a really basic example here. If you were to increase your prices by 10% and nothing else changes, then your profit should double. It should be 200,000 in the following year. Your sales or your revenue would be 1.1 million. So that's essentially the power of this. The bigger that your revenue is, every percent that you price up will make even a more significant impact there. Um, I guess the biggest thing here is the fear of losing customers. And so often when I'm talking to business owners, or I do also coach other accounting firm owners, and one of the discussions is around increasing prices. The biggest thing that stops people doing it is the fear of losing customers or clients, and that's definitely a valid thing to think about. But the way I look at this one, like even if you increased your prices by 10% and a few percent of your clients left, even if like let's just say 10% of your clients left, ballpark, you'll be about the same amount of revenue, but you'll have to do less work, if that makes sense, to earn the same amount of money or more. So even if you did lose customers, I don't necessarily think it's a bad thing. And often the customers who leave you are the ones that aren't aligned with you. They might value your services the least, and yeah, essentially. The other thought on this is often what our minds think up might happen. Like, hey, if I put my prices up 10%, 20%, I'm going to lose my whole client base. It's just not rational, and it doesn't happen. There is a way to do it though. It's not something you just go, like an energy company. I feel like that's really not focused on the relationship. Each year I get an updated bill after July. I just got mine the other day. And I was like, oof, that's a bit higher than normal. I look back at it and I go, okay, they've updated the price from 1 July. They're letting me know in the bill after the fact. Rightio. I don't think that's the way to do it. But again, I don't think we should shy away from adjusting our price and making sure we optimize that, because it is literally, I feel, the biggest lever we can do. The other thing is, and a lovely gentleman has spoken to my coaching group of accountants, but also our team about this, and he's on the call today. I can see him there. Thank you, Olivier, for joining. But Olivier has helped me and our team and quite a few other people we know to master their mindset around increasing prices. And one of his tips is that small, regular price increases beat big, rare or less frequent jumps. That's essentially from the emotional reaction to it. But what I want to talk to here is that what we've seen over the last 5 years when it comes to inflation and even wage price pressure has been incredible. And if your business hasn't kept up with increasing prices in line with that, then as the business owner, you are taking a pay cut. So you have to keep raising prices in line with at least those things that are increasing in your business. Otherwise, unless you're being more efficient about what you're doing, you are going to take a haircut there. And I guess for us, CPI and wage increases are a constant for us, and we are we're doing those regular increases in prices, and we recommend our clients do the same. And if you're in a weird industry where prices are stable in terms of your costs to deliver your service are stable, then you might not necessarily have that pressure pushing upwards. But I'm yet to think of a business that doesn't have that going on. But anyone who's got one, pop a note about what exists. Alrighty. But the next topic we're going to run through is reducing costs and improving delivery or efficiency, I guess. And if we think being one lever, costs being another, let's trim wasteful or bloated expenses. And the best thing to do is a line-by-line review. Now, again, with your ability to do line-by-line reviews in Xero, this is going to be easier or harder depending on how good your reporting is and how detailed it is. Remember, I spoke to having quite detailed profit and loss statements and that sort of thing. You can get that further detail if you look into the account transactions reports. And what we often help clients with is helping with this review, where we look at what, let's say, subscriptions have been doing over the last 12 months. And we see that often there's subscriptions that aren't getting used anymore, or you're paying for 12 users but only using 8, so we can actually cancel 4 of them. There's things like that often happen in business. And even if, like, even what we've done in the past is we've done this review, we've let it go 6 months without doing one, we've done another, trim the fat exercise, and we found more subscriptions that have popped up since we did the last one. So um, for us, or what I'd recommend is that this is done every 3 to 6 months, because as much as we think that we're not spending money on stuff we're not using, it often pops in there. Or, is there any other alternative that we can, replace a higher cost subscription with a lesser one, as an example. The other thing we can do is, I guess, to optimize costs is to be more efficient. So, what's an example here? Um, you know, let's say we were producing widgets, and one employee was producing 100 widgets a month. What would we need to do for that one employee to produce 120 or 130 widgets? Increasing their percentage so we get more out of what we spend on wages or people or labour. That's something that can be worked through business by business. It's very specific to everyone's here, and just looking at the people I know, they're all very, very different applications of how this might work. Even if you're in coaching, for instance, a lot of coaches do group coaching instead of one-to-one to leverage their time. Obviously, it generally is at a lower price point than the one-to-one, but that's an example of optimizing. Like, for every 1 hour you or one of your teams spend with clients, maybe it's group, you're optimizing that out. I guess that return on that 1 hour. All right, the next one here is reviewing fixed costs, rent, software, admin overheads. In business, we've got variable costs and fixed costs. Variable costs is, if we go to the widgets, and the widgets they're made of wood. We've got that variable cost of the wood. So the more units of widgets we sell, the more wood we're going to need. But within reason, I don't think we're going to need a big shed to manufacture the widgets in. And we just need to keep pumping them out. So that the rent in that example would be more of the fixed costs. And so one of the other things that's worth a review is that, are your fixed costs optimized? Are they appropriate for the stage of business you're at? We see business owners that they've got a lease that exceeds their needs right now. What are your options? Could you sublease some of your space to a related business that can reduce that net cost to your business? All sorts of things we can do. Yeah. And then when it comes to, I guess, optimizing costs and efficiency, one of the things you can do is benchmark against your peers or people in a similar industry to you for insight. And I think things like knowing what, roughly what other businesses in your revenue range and in your industry spend on rent or on wages or on, what's the net profit percentage, that can give you insight to sort of see how you're going. Obviously, I don't think that's, obviously comparing yourself to the industry might be great. It might actually not be too helpful, especially if you're a leader in your industry and you're comparing yourself to someone or to a group of people who aren't performing as great as you. So, take it with a grain of salt. But if you've got no other point of reference, that may help you, give you a bit of guidance on where you're at. One of the next topics I'd like to share is around cash flow. Again, I think revenue is okay. Profit should be more of a focus. But even then, often our clients will say, "Oh, that's nice. I made 200, 300, 400 grand on paper, but where did the cash go?" So I think we need to really understand what happens with cash flow movements, but also have strategy in place to optimize that and to make it as least stressful as possible. One of the relatively easy solutions to implement is to have separate bank accounts that you put different buckets of money to. Now, one of the really, really good resources, which I absolutely recommend, is to read Profit First. If this is one of your first times hearing about this, yeah, it's a really good written book, and it sort of shares principles around, when money comes into a business, we want to push that to different, to operational expenses, to owners' pay, to profit, and also to in our adaptation of this, we recommend strongly, at minimum, that you have an account that's for your quarterly things like quarterly BAS, superannuation, any of those big, less frequent bills, so that and you're able to, like, even in Inspire, we've got a daily amount that goes to that account. It just trickles out of the account every single business day, so that when the super run comes, which it's due to be paid any day now, for the June quarter, that we've got that money set aside. We hit the button in Xero to automatically pay that into people's accounts, and we go from there. So this is exceptional, and Mike, or Michael, in his book here, he gives an example where businesses are in strife. How do you recommend turning it around? And it's got some really, really good suggestions. And I've had other people I know we've used this method as well. I think we started using it in about 2015 or 2016. But even other people I know have had businesses that haven't been in great states, the cash flows, dramas everywhere, and I've implemented this, and it's helped amazingly. So yeah, would absolutely recommend that. And then, as I said, the minimum one we want is a separate bank account for things like super, tax, those big quarterly bills. We put aside money for our annual insurance premium, so that we're not paying the premium funding, which is usually, as a percent of interest, it's usually ridiculous. And can also have this, a separate account for building this cash reserve called a war chest, and that could be for a rainy day, or acquiring another business, or purchasing an investment property, whatever that looks like for you. So we've got cash flows squared away. The next thing we want to do is have a budget and essentially a forecast, or I call it a budget. The way we do it, and what you're wanting to do is best, and everything's a guess here, really. Your best to your knowledge, what are you forecasting your sales to be and all your expenses to be, and therefore your profit. You want to be doing this. So we do this every quarter, but we have a rolling 12-month view of it, if that makes sense. So let's say we're doing our budget right now in July, we'll go right through to June the next year, and then in a quarter we'll review that and go to 12 months from that point onwards. Because often, even though I sort of see we've got a relatively predictable business, there's still assumptions that change. We learn how to do things differently. People come and go, so assumptions, will definitely change over time. The other thing that gives you, and I think that this is such a key thing, like often business owners don't want to share the whole financials with the whole team. That is, there's something called open book management. I can't remember the book that shares that concept, but if you search for OBM, or open book management, which is basically just transparently sharing everything with the team, that is one way to do it, although I don't know that many people are very comfortable with that. What we've been doing at Inspire, again, this is like since 2016 or so, around those years, we've had this thing called our magic number. And what that gives is a weekly revenue or sales target that we need to hit. And we know if we hit that, we're essentially paying all our expenses and making profit, or our target profit per our budget. So that's what we call our magic number. And our magic number accounts for, because we do have recurring monthly revenue, we've got a subscription service. And so how we calculate this, I'm not going too detailed, but we say if we need to bring in $400,000 for the next quarter, and $200,000 is already on monthly subscription service, then we need that 200 grand gap to hit all our targets. Divide that 200K by the number of weeks in that quarter, and there's our weekly sales number, or our magic number. And that's the number that we share with the team, and especially the ones that are involved with sales. or work towards making sure we hit that number. So if you don't have something like that in your business, even if it's just you or a couple of people in the business, I still think it's important to get clarity around what that needs to be to pay all the bills, all the expenses, but also give you that profit target as well. Because we don't want to be taking so much risk. As a business owner, usually working more hours than a full-time equivalent, and being paid the same amount essentially as a job. So that's not the goal of business ownership, or I haven't met any people who want that. So if we want that, we need to be really intentional about how we go about doing it. Yep, and in that budget, you can forecast cash, profit, and owner's drawings. How much you're going to take out of the business needs to go into that, and that's from like an owner's pay perspective, like paying yourself a market rate salary, and also what your profit target should be. The next thing to do, and this is we use the framework called Traction. So the book is called Traction, written by a person called Gino Wickman, and the what do you call it? The thing is EOS that we use to do this. But basically, every person in the business in Inspire has a KPI, and they're not all necessarily tied directly to that magic number, but they're all tied to something or some things that are the most important numbers that person should be covering and be across. And we've got weekly and monthly meetings to keep those updated, and if they're off track, do something about it. So that will be the next step to go to after you've got your budgets and forecasts. And one of the things we do in our service, Total Financial Control, when we're helping our clients do these budgets is, well, to bring in $100,000 a month of sales, how many things do you need to sell? All right. So to sell those many things, let's say there's 20 things to sell. How many sales conversations do you need to sell 20? Because not every sale conversation will necessarily lead to a sale. All right. So you need 40 conversations, right? To get 40 conversations, how many leads do you need? Yeah. So we work backwards to those KPIs, and then we've got our sales and marketing KPIs to make that revenue happen. So there's a fair bit that goes into it. But yeah, and I'm keeping it a little high level in this run through, given the amount of different topics we're covering. Yeah, the other thing that that is important, and I sort of guess this depends on the type of business you run, is the importance of working capital. And I might go to the next slide because it gives examples here. But if you carry a lot of debtors, as in people who owe you money, if you've got payment terms of 30 or 60 or 90 days, you've got a lot of cash tied up in your clients' bank accounts. It's technically yours, but you've given them payment terms, or they're pushing out your payment terms in terms of that, and your cash is in their account. With creditor days, there's some suppliers that might give you 30 or 60 days to pay a bill. If you're paying it in 1 or 2, you're paying it earlier than you need to, and that might be admirable. But what you're doing is you're losing that working capital report and putting it in someone's bank account before they require it from you. And the same with stock or work in progress. So work in progress is more relevant for professional services, or it's not just that, but anything that you've got that you're building, or you haven't yet built, but you're working on. That's the WIP part of it, and then stock. The easiest way to put this is, let's say you run a small supermarket. The stock on your shelves often you've paid for, so that's the cash that you've got sitting there, and all of these things are very relevant to the amount of cash that you've got in your bank account, and optimizing each of these things will mean more cash in your bank. For instance, let's say you're a shop and you sell 10 bloody jockey wheels. You're a 7-Eleven servo. You sell 10 jockey wheels a year. And you've got 30 on your shelf. I mean, you're overstocked. Maybe you're waiting for some sort of weird trailer epidemic. But again, what you've got in that instance is you've got from an accounting perspective or a working capital perspective, you're wasting money on stock that doesn't turn over so frequently. As an example, or the other one with WIP, I see so many times that in professional services you don't regularly bill, and what I think we should do is have regular intervals, even if it's weekly, that you raise invoices to constantly clear your WIP and turn them into debtors, because that's going to mean money in your bank account quicker. Similarly with debtor days, people who owe you money, ways to deal with that is shortening your payment terms. Instead of 30 days, give someone 14 or 7 days, or take payment on or before delivery. That's another way to do it, and that essentially gives you that control and takes risk away from your own business. With creditors, you can always negotiate longer payment terms if that's viable, but I think that we need to do that carefully to make sure that we're not pushing boundaries with your key suppliers. And again, the goal here is that even if your debtor days, so the average it takes you to get paid is, let's say, 30 days, when you get it down to 29, that's going to mean more money in your bank account. It's just maths. It's really just accounting when it comes to this stuff. So the more optimized we can be about these cash flow days, the better for you. The next topic here is on bookkeeping and reporting rhythm. I did speak a fair bit about this at the start, saying that we want good numbers, good clarity, detailed reports, and we want them done timely. What I recommend is that you get a bookkeeper engaged at least weekly, because even if you're doing it monthly, what often happens with bookkeeping is that there's questions that they're going to have for you. And if they're sitting down to process your stuff every month, and then they ask you a set of questions and they're not going to sit down and process the answers to them for the next month, you're going to have huge gaps in your ability to run the reports. So I recommend weekly, because you're going to keep on top of those things that might get out of hand. Make sure they're a good bookkeeper. And I've said this a few times, but I reckon a good bookkeeper, to some degree, is more important than a good accountant, because a good accountant is useless if you've got a crap bookkeeper, because the accountant's not going to be able to help you or interpret the numbers if they don't make sense, or they're bad, or all that sort of stuff. So, a great bookkeeper is worth the weight in gold. The other point here is that I still feel like you still need to review their work and what they produce. Only you have the context as the business owner, and they're not going to know if something weird's going on. Maybe they will, I'll say, but often they if let's say there's a double payment, they don't know it. They might just think that you've paid something or order it twice that month. They might not necessarily pick that up, but if you see that, oh yeah, this month our expenses are double in that account for some reason, that doesn't make sense. Why is that? And I feel like even that's the sort of review that we need to be doing as business owners, scanning through the accounts, making sure it makes sense to us. If it does not make sense to us, interrogate, like, why is that not the case? Why is there an expense missing in that account this month? And try to work out the problem. Sometimes it can be a missing invoice. Sometimes it means that my credit card got hit with fraud a couple of months ago, and trying to, like, all our subscriptions on direct debit, sometimes they miss, and there's a gap in that payment. It doesn't mean we weren't charged for that month. We're basically paying for it twice in the following month. So, yeah, all those sort of things. Your context is going to mean, I guess, overlay to make sure those reports make sense, and you're able to then make decisions based on that. And again, I'm not saying that I don't expect my bookkeeper to be perfect. Absolutely not. It's about collaboration, and again, more so the context you have is not going to be as good as theirs. Looking at what's coming into the bank transactions, and whatever's being put into your invoicing systems. Of course, the goal of all of this, making better business decisions to increase your time, money, and happiness that you get out of your business. But your reports, assuming that you've got this squared away, should help you to answer questions like, are you making money? Is it what you're aiming for or not enough? If it's not enough, what do you do about it? And what can you adjust? If it is enough, fantastic. At least you get that confirmation. Can I hire or can I afford a new hire? That's a question that we get asked a lot. We've got forecasting software that we use to help clients answer this question, and we can work out if they hire someone in the month of September, what does that mean for cash flow? What if it takes them 1 or 2 months to become, to start? We work with a lot of physios. If they start seeing patients, they don't instantly become 100% busy. That might take a few months lead up to do that. So what does that look like in terms of your payback period to hire the next employee? The other one there is, should I increase my prices? What impact will that have on the business? You can model things like, hey, if I increase price by 10% and 5% of my clients leave, what does that mean for profit? What does that mean for revenue? I guess that's the sort of certainty or information that you want to be able to run from the reports that you have. You can even go further. You can create dashboards for this stuff. The EOS system that I mentioned before from that book Traction has really good ways to report this into leadership meetings, monthly meetings, and being able to plan with your business. It's fantastic. And even setting up reviews like a board meeting. If you've got other business partners or let's say your spouse is involved in the business, this is fantastic. And I think definitely one of the things that needs to be tabled at those meetings is your monthly reports, how you're going from a financial perspective, along with other things. It's not all about financial reporting, but businesses definitely need good controls in place around that stuff. So I've covered the content that I wanted to run through today. In terms of next steps, this is very much for our clients. We do only take on what we call total financial control program client businesses who are already existing tax and accounting clients. But this is if clients on the call do want some extra help with what I've spoken about. Some of the things I've already mentioned what we do, but just to run through some highlights of what we help with this service is we set up budgets, cash flow plans. We work out what sort of structure you need around your bank accounts, things like and by the way, if you're listening and you're not a client, take these as literally like action points, by the way, to do, whether you self-implement or you want to work it out with us later. But yeah, things like structuring your bank accounts, how much do you put into each of those accounts each week, each month, or if you're like us, even each day. Crazy. Calculate what your magic number is, what's your weekly revenue target, how much tax do you set aside each, whatever frequency, and then also customizing your reporting. So we help you sort of deep dive into what we believe it should look like. We're very much pretty heavy in the onboarding process, and then what we do is meet with you usually monthly or quarterly, depending on what sort of agreement you would like to go on. And what we've noticed here is that most clients, by about month 12 to 18, somewhere in between that, they become self-sufficient and they're able to continue that system from there. So we don't see this necessarily as a lifetime program. It's something that helps instill a system. So there's heavy lifting with the setup, and then there's that ongoing training and coaching, and then almost like training wheels, we just slowly let go of the bike and hope that nothing bad happens. All right. Well, I have covered a lot today. If you are a client and you do want to talk more about what that total financial control service looks like, then please reach out to the account that you work with at Inspire. If you don't work with us at the moment and you want to explore what that looks like, then you can book in for a strategy call with one of our accounting team. And you do that with the QR code on the screen at the moment, or there will be a link in the chat box. And I just want to say thank you for joining me today. I hope the background has been pleasant. It's definitely more pleasant than the bookshelf in my usual one. I just wish I was facing them that way, but it's nice to be able to see it. And I will stay around for the next few minutes if anyone does have any questions on what we've chatted about. But thank you very much. And also thank you to Rose and JB for helping me put this webinar together and bearing with me through all those tech issues. Thank you very much. Thanks, Kylie. Yeah, so any questions, either take yourself off mute and we can chat through them, or we can go through with chat box. Thanks, Nick. Thanks, Melissa and Olivia. Thanks, Alison and Tanya. Appreciate that. Hey, Craig, interesting. I've been wearing your well, not your hoodie, but the hoodie from your business down here at Coolangatta, and someone came up to me and said, "Hey, are you from Tamo?" I'm like, "Whoa, Tamo, what?" But it made sense when he said it was about the jumper I was wearing. Thank you, Natalie. Good to see you. Nick said, I was wondering about the accruals process. How do you track that? So with accruals, I guess the important thing with that is when an invoice, like let's say you've paid the insurance bill annually, or you've just paid the big bill for the year. Instead of the bookkeeper entering that in the month that you paid it, let's say we're in July, they put the big expense, let's say $12,000 in July. What they need to do is put that into prepayments. It's an account on the balance sheet, and then they write off 1/12 of that amount, or $1,000 a month over the next 12 months. And there's a manual journal process to make that happen. And what that does is, like, the cash might come out in 1 month, but the actual expense relates to all those other months as well as this month. So that's what we call accruals versus cash basis of reporting. Cash is simpler, but it doesn't necessarily give us the insight, because if let's say I'll be ridiculous here. Let's say we pay all our team and all our bills annually in advance. So in July, all our expenses are paid for, and then we bring in sales throughout the year. We're going to get to August and September, and all our sales are just going to show as straight profit. But that's not true, because there's portions of that money we pay as other periods. And so that's the whole concept of accruals. That's a very what's the word, polarizing example I gave you. But what normally happens is, most of the time, cash, especially if we've got monthly expenses, cash and accruals is not going to show a big difference. But it's a number of different differences. If you've got annual over here and quarterly bills that you pay over there, that is going to have a real, a tangible impact on what you see month to month from a true profitability perspective. Yeah, I hope that clears that one up, Nick. All righty. Well, I can't see any other questions that have come through. I trust that was helpful for everyone. Nick has would you do something similar to wages? Again, I prefer to pay monthly wages, because and that's why we've got fixed salaries. So literally we take the person's annual salary, divide it by 12, and it's always equal in every 12 months. If you've got fortnightly or weekly, you will have differences month to month. Obviously, if you want to change to something like that, you need to get your team on board. So just make sure you maybe give them advance notice. And I'm not sure on the rules; it might be different state by state. But with monthly pay, we've got to pay in the middle of the month for that month. So our pay date is usually the 15th of, let's say, July, and it relates from the 1st to the 31st of that month. So our team are getting 2 weeks in advance, 2 weeks in arrears. I don't know that it's legal to pay 4 weeks or a whole month in arrears. I'm going to just look into that. But it works for us. Yeah, definitely more consistent for reporting.
I thought it might be easier to turn my mic on. So you wouldn't take, so if you're paying your wages, say fortnightly, you wouldn't then put that in as a manual journal and adjust it to an accrual basis?
You
Is that just
could.
too
It's
much
just
work? Yeah,
basically. Yeah, I sort
yeah,
of feel like it's a lot of work for the outcome. But if you've got no other option to, like, let's say you can't pay monthly, or with team resistant, whatever the scenario is, that would be your only option to get true accruals, is to journal it. It'll just be a bit of a pain. Thanks,
yeah.
Craig.
Okay, makes sense. Thanks.
No worries, Nick. All righty. Well, if there's no other questions, we might wrap up there. And thanks again for everyone who's joined. Really good to see some familiar faces. All right. Thanks, Olivia. Thanks, Steve. See you at the next webinar. Oh, he's typing something. I'll wait for it.